Hello and welcome to a brand new show of Market Makers. My guest on the show today is someone who needs no introduction whatsoever. I've always maintained in the past that he's indeed one of the best stock pickers on D Street. Hiren Ved of Alchemy Capital Management. Hiren, what a delight to have you back on ET Now. Thank you for joining us.
Thank you, Nikunj.
Characterize the market environment for us. A week ago, or I would say 10 days ago, everyone had written an obituary for Indian markets. Now, looks like the carnival has started.
Yeah, I mean, it's what a change a couple of weeks or days can do. I think clearly this was, in a way, unexpected. But I think the tipping point is very clearly, which I think everybody knows, is that the turnaround started the moment commodity prices cracked, especially gold and crude and some of the industrial commodities. And clearly, India is an anti-commodity play. So, you know, commodities go down, India goes up. I think that's broadly, if I were to summarize, is what has kind of tipped the scales in favor of India. And that's how probably most of the global macro money is looking at. And suddenly India has become, back in flavor because of the turnaround in the commodity prices.
Do you think bulk of the macro adjustment is now behind us because commodities now have stopped falling? They are not appreciating, but they are not falling further now.
Well, I think, nowadays markets discount everything pretty quickly. So if you ask me that for the first round of the commodity fall, have we already got the dividends? Probably yes. But we don't know whether commodities will fall more. It really depends on, what happens to global growth and specifically what happens to Chinese growth. Typically, classic example is gold, right? I mean, I see a very similar pattern to what we saw in equities in 2008. When any asset class has been in a bull market for several years, the first time there is a crack, people rush in to buy because they think there is great value. And that's what's happened in gold. For example, with the fall in price, we've actually seen demand go up dramatically. So I think that, if you look at the price movement in commodities, I think you had the first leg down, then probably, you will get some clawback, it'll consolidate, but it's still looking very weakish. So probably there's more to come, and hopefully that will be good news for India.
So if global markets correct, and especially if developed markets they correct, do you think that will have an impact on Indian markets, or Indian markets are now isolated and insulated because for India the macros eventually are improving?
I don't think that any market can be insulated. So at least from what I have understood over the last few years is that ever since the participation of global money in India has increased, the global context overrides everything. So that's very important. Now, over and above that, you overlay what is happening domestically. So if you have a situation where global is favorable and local is favorable, then you have the kind of move that we've seen, because both are moving in tandem in your favor. I've seen a situation where domestic news is not good, but global is favorable. Then the impact of the bad domestic news is not that significant, right? But if you have, conversely, if you have a bad global context, and on top of that you have the bad local context, then, you really have depressing times. So I think that it's the interplay of the global and local, but I think at least at this point in time, until domestic participation increases in a big way, I think what happens in the global context is far more important to the markets, at least in the short to medium term. In the long run, obviously, how earnings catch up and how how our policy moves will define what happens to India.
But isn't it ironical at a time when risk-on trade is at play, global volatility is low, equities, which is always perceived to be in risky asset class, that is making a roaring comeback. Markets are still pro-defensives. Quality is going up. Classic industrials and classic beta stocks are not making a comeback.
Yeah, I mean, typically, if you see, there are the investment community kind of gets into a kind of a fad or a trend which lasts typically between 8 to 10 years. So if you say the decade of 2000, emerging markets was the flavor, not the developed markets. Similarly, if you look at even in the Indian context, right, the industrials, the infrastructure companies did phenomenally well in the 2003 to 2008 boom. They were the leaders of the previous bull market. In this new sideways market, which, post the crisis in 2008-9, it's really the quality which has outperformed. And I think that this trend is continuing. So people are just wanting to chase what has done well. And I find it difficult that this trend is going to change very soon because, public memory is still alive to the fact that what happened to mid caps, what happened to all the companies which were highly leveraged, what happened to companies which misallocated capital. I don't think money is going back there soon. Despite
even though
the
optically
fact,
they look cheap.
Even though they look cheap, I think that, the money is not going there. And I think that because money is chasing those same few names, and that's where the performance is, it's a self-fulfilling prophecy. And typically these trends can extend for a longish period of time. I think we are 5 years or 6 years into this trend. Who knows? I mean, this could continue for a while. I think that, the classic example I give is that if you invested in levers in the year 2000, 100 rupees became 145 rupees, including dividends, in 10 years from 2000 to 2010. But if you invested in Larsen, 100 rupees became not 140 but 1400, right? But that regime has changed. I mean, today the consumer stocks are hitting new highs.
So your trade of the decade is consumers?
I think so.
And you are in no hurry to reduce your exposure to consumer and pharma stocks?
Well, I think that, some staples might be very expensive, but not all consumers are that expensive. I mean, we've also seen some consumer stocks correct.
So what do you like within the consumers then?
Well, we still like Bata. It's something that we've held for a couple of years. It's done well. There has been a slowdown in the consumer markets, and first quarter and last 2 quarters, the top line growth was not as strong.
The bottom line also has contracted.
Yeah, I mean, typically for these companies, it's very clear, the operating leverage is very high. The top line grows, it all falls to the bottom line. But I think that these are secular stories. I mean, it peaked at about 950 or so towards the end of last year, calendar year, and it corrected to almost 700 rupees. So we had a steep, at least 25-30% correction in the stock. But at around 700 levels, you were able to buy a leader in its field at 7% free cash flow yield. And I think that if I look at the numbers 2 to 3 years down the line, what is a 20-25% ROE company, I think can easily become a 40-50% ROE company because these guys will just keep compounding at 15-20%.
No dilution, no
dilution, and there is a lot of headroom to grow. I mean, even today, for example, the per ticket size invoice value of Bata is 320 rupees. I mean, incomes are going to rise, and clearly the invoice value is not going to remain at 320 rupees. 3 years ago, the invoice value was 240 rupees.
Bata has been part of your portfolio for last 3 years now. Do you think it could remain part of your portfolio for next 3 years or maybe more?
Or maybe more. Mm-hmm. Clearly, I think for the next 3 to 5 years. Mm-hmm. I don't see why it should not continue to compound and grow. I think that there is a lot of headroom for growth still.
Your top 3 holdings or your top 3 portfolio holdings haven't changed much in last 2 years. Tata Motors, Lupin and Bajaj Finance or Bajaj Auto Finance. Why is that?
Because they continue to deliver. I mean, classic example is Bajaj Finance. For example, we've been holding it for almost 4.5 years now. I mean, we bought it when it was still very young. It had just gone through a very difficult phase and it got recapitalized. They had a new management team which came in place. And I think that I wouldn't be wrong to say that it is one of the best management teams in terms of execution, the way they have turned around the company and grown the business. And we bought it when it was sub 1-time book.
That's 3 times.
And today now it's still at 1.7 times book. But the book itself, profits have grown at 30-40% compounded for the last 3-4 years. So we not only got the earnings growth, you also got the multiple expansion, because once the confidence comes in, I mean, I see no reason if Shriram Transport trades at 3.5 times book. Obviously, they have a long track record of doing well. I see no reason why, for example, a couple of years down the line, a Bajaj Finance can't trade at 3 times book.
The criticism for Bajaj Finance is that they are too focused, they don't have a reach, and if consumer slows down, then they really don't have a NPA strategy in place, because up until now, that business has not seen a stress cycle.
Yeah, I mean, I do agree, but I think that there are 2 or 3 reasons for that. One, I think that if you ask me, they have always been, it's not that as a management they have not been aware that there could be a stress in the cycle. In fact, they've always provided ahead of any potential stress that they might see in the book. But the fact of the matter is that their credit processes are very, very strong. And I think that's one reason why they've been able to keep their NPAs low. For example, they did go into infrastructure financing. Yes. But when they realized that there was stress, they scaled back that business. They never grew that book. And they were very, very focused on seeing that they keep the book very tight and they keep the NPAs low. So they are a management which is very conscious of the risk. And I disagree. I think that they started as being a two-wheeler financing company. From two-wheeler financing, they've now moved on to consumer durable. They are one of the largest consumer durable financing companies in the country. And now they're moving on to, loan against properties. They're doing SME loans. They're now going to get into credit cards this year. And I think the headroom to grow is tremendous. I think they've got the model right. They've got the management right. And they're building their distribution. They also earn a lot of fee income by selling insurance policies of Allianz. Yeah. So I think it's a good business which will continue to compound at 25-30% for the next foreseeable future. And I think that there is more headroom to grow in terms of valuations, because now I think that people are beginning to stand up and look and say, oh wow, through the cycles, this guy has managed the NPA cycles very well. They've grown, they've kept the quality intact.
So the checks and balances, according to you, are in place. There's one stock where there are some question marks, which is Tata Motors. Given the kind of economic news we are getting from China, and Chinese market are an important market for JLR, do you think the Tata Motors to the JLR story now is under threat?
No, not actually. I think there was a bit of a slowdown in China. But from what I understand from some of the brokers internationally who've gone and done some dealer visits in China, the dealers are pretty excited about JLR. I think that product still commands a premium. In fact, while there was discounting by some of the other brands in China, Jaguar had no discounting in terms of pricing. And they have a fantastic lineup of new products that is coming up. So it's still a very aspirational brand in China. So I think China has done well. I think people forget, but even the US market, which is very big, is doing well for them. UK has grown suddenly, which is their home market. And they're now getting into newer markets like Latin America and Saudi Arabia. So I think that there is a lot of momentum which... so there are two things. One is that there is a huge new model lineup, and there is a mix improvement that is still possible and potential. Obviously, the domestic car business is struggling very badly, and my sense is that they have now gotten on to that we have to do something about it. And knowing that Tata's sometimes they move slowly, but once they recognize a problem, they will probably fix it. The only problem is that it's not fixable so easily. I mean, when you have to revamp your entire car portfolio, it takes a while before you get a new platform, a new product up and running. It would take 18 to 24 months to do that. But if you are able to stop the hemorrhaging that happens in the business, that would be good. And hopefully sometime during this year in FY14, we should see the CV business come back, which is actually the much more bigger...
The bread and butter business.
The bread and butter, the profitable high cash flow business in the domestic balance sheet. So as long as CVs do well and JLR does well, the car business can be handled for a while. And it can wait a little bit of turnaround. But the engine is clearly JLR, and hopefully if the CV business can kick in towards the second half of the year, I think with mining activity is expected to pick up, because the Supreme Court is now allowing mining to restart in Karnataka and selectively. Hopefully that should start feeding into once these mines open in the next couple of months. I think truck demand should come back sometime in the second half of the year. So that should help. And the valuations are not very demanding still. So
you've been hot and cold both on private banks. You've not taken a secular bet on any single bank, but you like financials as a group. So how are you approaching financials now, apart from Bajaj Finance?
No, actually we did. We do own 3 banks, other than Bajaj Finance, which has been actually our number one financial bet. We do own ING. It gave us a lot of pain in
Stock
the initial...
is up 70% in last 1 year.
Yeah, I mean, finally now, we just sat on it for like 2 years, and, the turnaround took some time. And I think sometimes what happens is that the market wants to see the durability in your turnaround. Finally, that has happened. And, all the patience that we had is now paying off.
So the cost to income ratio problem for ING, you think that's passé now, that's been sorted out?
I think that they're continuously improving on that. There is still some room for improvement. And I think that, Shailendra Pandari has done a fantastic job there. So we are still positive, and finally that has worked for us. So, the other one, which I think is still work in progress, is Federal Bank. Again, that's a bet that we've had for a while. It is taking a little bit longer. There are some legacy NPA issues which keep coming to the fore. But I think that in FY14 that should also get sorted out.
Are you worried about the exposure to the gold market? Because the day gold prices came down, Federal Bank was the first one to take a knock because they have a large exposure to gold loan.
Yeah, I mean, all the south-based banks do have an exposure, but we are not too worried. It's not a very large exposure. Again, I think the management is pretty well aware of what is happening there. So sentimentally, yes, there could have been, but they haven't seen any significant NPAs on account of.
But Q4 numbers were bad.
Q4 was bad, but that was not because of the gold loan, but that was because of some legacy SME lending issues or some, 1 or 2 large industrial clients, which I think, given the current environment, is very likely that those issues will keep coming up. But I think that those are now more of legacy issues. Those should get wind down in a quarter or 2, and I think improvement should start. So, and then the third one is ICICI Bank. So we have been holding ICICI, ING and Federal for a while, over and above obviously Bajaj Finance, which has done quite.
Your big call for last calendar year were 2. Number 1, United Spirits, which has done exceptionally well. My compliments for that. And the second one was Glenmark Pharma. Again, that stock has been a marked mover. What are your big ideas, out-of-box ideas for this financial year?
Well, I mean, I wouldn't call it out of box, but we got out of Glenmark.
At the right time.
Yeah, I mean, hopefully, we made good money on that. But the stock that we now like is Cadila. I think, they've had issues with the US FDA for a while, but they're a high quality management. They have some interesting products in their pipeline. I think FY14, second half of the year, they should see some pretty significant launches in the US as well. So we think that there is a lot of potential there. So we've taken a significant bet there. Amongst the mid-cap, we also like Ipca Laboratories. So these are two companies that...
Ipca is a very low margin business, isn't it?
It is, but you know, it is. I think their proportion of sales from the U.S. market is going to increase. It's still very small. We like it because it is one of those few companies, you know, which is fully integrated. So they're very, very strong in API manufacturing. They have leadership position in anti-malarials. So pretty much in a way, I mean, it's not a right comparison, but in a way, just like Lupin, you know, they were very strong because they had leadership manufacturing positions in API, and then they moved into the
they moved up the value chain.
Yeah, they moved up the value chain. I mean, there's a long way to go for Ipca, but I think the strength for them lies in the fact that they are very, very strong in certain, you know, APIs, and they're fully integrated. And now they are also looking at their own niches, you know, in the marketplace, and I'm very confident that next 2-3 years, you know, they will move up the value chain. There is potential for their margins to expand, along with increasing top line. And we like the management. They're very conservative, very clean, you know, good guys. They've always delivered.
If I map what the index has done for FY13, there was hardly any appreciation. The Nifty was up 6%, Sensex was up by about 5%. Do you think for FY14, Indian markets could register a double-digit gain?
It's possible. I think, you know, I think in everybody's mindset, the model that people have is that now whatever has to happen in India will only happen post-elections. But my sense is that if the macro improves dramatically, so if this whole trend of commodity prices falling, inflation falling, you know, extends aggressively into the year, you may have a situation that pre-election you may have a new high. You may then scale back. That's a different question.
So is that a big call that we could see a new high for the Sensex or the Nifty before elections?
It's not a certainty, but there is definitely a probability, I would say.
Would you, in terms of probability, would you give me a number on a scale of 1 to 10?
I think 5 or 6.
You're hedging yourself.
No, I'm not hedging. Because I still feel that, you know, there is still a large part of the market, you know, the breadth of the market has to improve. That is not yet improving on a sustainable basis. It is still those few 20, 30 stocks
very polarized,
very polarized, that is driving the market. And for a real bull market to start, at some point in time, the breadth of the market has to improve. I don't know whether that will happen within the next 12 months or will it take a little more longer. It doesn't matter. I mean, you know, frankly, we might still be range bound, but the range might be higher. And maybe it happens in 12 months, maybe it happens over 18 months.
Eventually we will get there.
Eventually we will get there. I think we've already spent 5-6 years in a range, right?
So time to sell gold, break that fixed deposit, maybe open a demat account and start investing in equities.
I think so. I think that I'm not an expert on gold, but I certainly think if you look at the history of gold, it has a step function. It outperforms for a couple of years and then it does nothing for many, many years. I don't think that there is any value in Bombay real estate, at least. I don't know about anywhere else. But, you know, these were two asset classes which took away a large portion of people's, you know, contribution away from equities. I think a lot of money is going into the fixed income because people want to play the drop in interest rate cycle, which is not bad actually because you could make good money. I think eventually, therefore, I think that at some stage that money will go out, you know, will come after they've played that cycle at some stage. You will see that money coming back into equities. It'll happen. We are also, you know, let's wait. I'm optimistic that it'll happen.
But I guess we are in some kind of in disguise bull market already because
yeah, I think this
40% of the index is at an all-time high.
This is bull market by stealth.
Yeah.
I mean, if you are just in the right stocks, you have no, you can't complain really, because many of these companies are at new all-time highs and they've given strong returns.
So stay with quality and revisit equities as an asset class. Really appreciate your time here, and thank you for your
Thank you so
wonderful
much.
and robust insights.